Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the 4th session of the It's Your Money workshop series. The topic for today is today's investment world. Our moderator is Peter Kote, our guest speaker is Paul Horn, and this webinar is brought to you by Chapman University. Enjoy the workshop.
Today's presentation is going to be Paul Horn, and Paul is a fee-only fiduciary financial advisor. Paul, could you just kind of briefly put your Ask First form up just so that people could see that it's there? And then we're going to I wanted you to see all of his credentials. And
yeah, there it is.
There it is. You know, Paul, you've been in the business 20 more years, and how come you don't have any kind of relevant license?
Relevant license?
Yeah, you don't have a license.
I don't have a license. I did give them up because I don't need them.
Yeah, let's take your Ask First down and let's just chat for a little bit.
Sounds good.
Tell me what you presently do.
Yeah, so my job is I'm the director of financial planning for a registered investment advisor here in Orange County. We manage 1.4 billion in investments, and I lead the financial planning team. We have 8 other CFPs and 2 CPAs that I work with to help provide comprehensive financial planning for our clients. Been doing this now for over 20 years, as you said.
And the reason why you don't have any licenses is
because I went from the dark side to the light side, if we have a Star Wars reference here. So a little about my background. I started out in 2004, early 2005 with Wells Fargo as a financial advisor right out of college. Got my Series 7 and 66 licenses with them. Those are licenses that you use to be able to sell investments, commission-based products, typically is what you're thinking there. I worked on that side of the house with Wells Fargo, USAA, and JP Morgan up until 2013. In 2013, I was at JP Morgan. I was called out on a call that was with every financial advisor across the country. My name was one of about 7 listed that didn't sell an annuity. And so I was called out by my boss's boss for not selling an annuity because annuities are highly commission based and they're great revenue for the bank. And so they were mad I wasn't selling their most high revenue products.
Yeah. Yeah. So today you're with a fee only firm. How do you charge your clients?
So we only get paid by our clients, the fees that they charge. Our fees come in one of 2 forms. Most of our clients use us to help manage their investments. And for comprehensive financial planning, we charge what's called a 1% AUM fee. That's assets under management. So if we manage $100,000 for a client, that's a fee of $1,000 per year. That's just 1% times the amount. And that includes everything. No other games, no other fees. Try and keep things simple because life is complex enough.
And who do you use as a custodian?
Great question. So all the money for all our clients is held either at Schwab or Fidelity. It's not held in our name because that's how we avoid Bernie Madoff situations.
Yeah. So today, what we're going to be doing is, we're going to go over some of the typical products that are in the investment world. And 95% of the individuals, approximately, are are commissioned or brokers working for a Merrill Lynch or JP Morgan or Edward Jones, etc.
Yep,
So we'll start the program, but first of all, let's go through a little bit of the definitions. What is a registered investment advisor versus a broker?
that's a great question. So with our industry, it is kind of weird because there's two sides to the house. Um, Most individuals these days are moving towards the registered investment advisor. That is someone that is completely independent. They don't have sales targets. They don't have to report to anyone, and they can do what's truly in the best interest of their clients. The main thing here is we're trying to hold to the fiduciary standard. Simply means we're just trying to do what's in our client's best interest at all times. The other side of the house, which is the old school side, those are the traditional stockbrokers that you think of that unfortunately do still exist. This is where I was with JP Morgan. And with that, it's a broker, or what's called a registered representative. And this one is more transactional, typically selling commission-based products like life insurance, annuities, commission-based mutual funds, things like that. And this has a different standard. They just have to do what's in your quote unquote best interest. So they might sell you a product that you need, but they may not choose the best product for you. They may choose the best product that pays them the highest commission.
How do we know who's who? I'm talking about FINRA. What is that?
Okay. So with FINRA, we're looking at so FINRA is a self-regulatory organization. Okay. So it is a group of, it's where JP Morgan, Wells Fargo, all the, Merrill Lynch, all the Wall Street banks got together and they decided to self-regulate themselves, put rules in place that kind of holds everybody accountable to the same standards. The idea here is trying to provide some sort of accountability to the public. And number two, and more importantly, keep the US government from getting too involved. And the US government agency that oversees my industry and oversees FINRA is the SEC, the Security and Exchange Commission. They're in charge of all security transactions, all activities of financial professionals, and all trading. So their goal is to try and root out the bad stuff.
Yeah, the SEC is kind of, the philosophy is, if I give you all the information that's possibly available, that you as a reasonable person can make up your own mind. And so you provide what's called an AVD form for your clients, which gives full disclosure on yourself and the firm. Is that correct?
Yeah, so every firm in existence has to do an annual filing with the SEC. So that's what's called the ADV. The ADV has all our information from what our fees are to the services that we offer to how much we manage, the typical client we're working with. If there's been any accusations or lawsuits, those are listed in that. So a lot of very valuable information. There's the long version, which is over 100 pages. And then there's what they call the ADV-2, which you can get from just about any advisor's website these days. And that's like a 3, 4 page summary of that 100-page document.
Yeah. One of the things is that FINRA operates a database. It's called Broker Check. I don't know if we want to go to the FINRA website, Paul. I'm not sure if we have the wherewithal to do that right now. But if you can, well, here you go. You're doing it. All you have to do is Google Broker Check,
And then it's going to be the first link. And
and
then
then
here you can
let's
start. Sorry, go ahead.
no. Why don't you go ahead and put your name in?
And then I'm right here.
There you are. And so if we click on you,
Now, some of you that are astute observers might notice I said I have 20 years of experience, but this only shows 12. I'm not a liar. What this is counting here and what this is tracking primarily are the brokers. So this is under my licenses when I had my licenses. I've been doing this for 20 years. I only held my licenses for 12. So 8 of the years I have been unlicensed, like Peter talked about, meaning I don't have the 7 or the 66, meaning I'm not selling commission products.
You should, anybody who sell or anyone who's in the financial world, whether they're giving advice or selling products, is going to be listed on FINRA and you should look them up. You have zero disclosures, which is really good, but what does a disclosure mean?
A disclosure means they did something scandalous. So this could be an unscrupulous sales practice. This could be them filing for bankruptcy themselves. I don't know about you, but I don't know that I want to trust my money with someone that filed for bankruptcy personally. So anything about the individual you will find here. When you do these searches, you can also search for the firm, which I would recommend if you're looking for a financial advisor. So you can look at the firm to make sure the firm itself hasn't been held reliable for bad sales practices, fraud, things like that.
Yeah. And one of the things is that if an individual has never been on the brokerage side, the FINRA website will take you to the SEC website. And this is what the SEC website looks like.
Yeah.
And again, it's everything is about full disclosure. So if there was a disclosure for Paul, it would be on the list.
Yeah, it'd be right here. It's first item listed.
Yeah, yeah, and so please, you need to look up whomever. Uh, I you may want to, if you have an advisor, you may want to look them up if you have never done it, just to see get a little bit of their background. Everybody should, if you were an attorney, you should look them up on the bar search. If you were a CPA, make sure you look them up on the CPA website. So insurance is same thing. These databases are there to inform you as to who they are and whether or not there's been a problem in the past. How do you find a financial advisor?
Uh, Most commonly, it's still old school. Most people, it's still, referrals, word of mouth, or from a trusted source. So most of us, our clients find us from existing clients or from other individuals we work closely with, like CPAs, estate planning attorneys, things like that. So if you are looking for one, that's always the best place to start. Otherwise, Google is always a good help. Um, Things that you should be looking for is number one, you always want to try and find that fiduciary. If you remember, we talked about the two sides of the house, the broker dealer and the RIA. You want to find someone that's an RIA that's hopefully being a fiduciary, doing what's in your best interest at all times. Another layer to that. So let's take the brokers out for a second. Just talk about RIAs. When we look at an RIA, that's an independent advisor like myself, and they can do one of two things. We choose to be fee only, meaning we don't sell any commission-based products at all at our firm. So things like life insurance are commission-based products. I was licensed and sold it for 16 years. I don't do that anymore with this firm. And we do that to avoid conflicts of interest, right? If I tell you you need life insurance, it's because you need it. I'm not making any money on it. Where if I tell you you need it and I sell it, it's hard to kind of tell if it's in your best interest or not sometimes.
Yeah. So a great question would be, how are you paid? By whom? Are you
Yes.
paid by anyone else except for your client?
No referral fees from CPAs or attorneys, no commissions, no other games.
Education, credentials, you have them listed there.
We do. So, a lot of advisors will have alphabet soup behind their name. I mean, I myself am a CFP, CPWA, and Masters in Investment Management. But really, the only two or only three that matter is a CFP, someone that specializes in financial planning, CPA, right? Someone that specializes in taxes, or the CFA. Sorry, I have the hiccups here. That's someone that specializes in investments.
Yeah.
These are the three oldest, most respected designations out there. There's probably 5 to 10,000 other designations available, but most of those are just pay to play. You pay a fee and you get your credential and you move on.
Yeah. And remember, just because if you're a CFP, that does not mean you don't sell product. So you got to
Mhm.
ask. Uh, it's my understanding that 70 to 80% of the CFPs do have an insurance license. So,
That is correct. And just because you have a CFP doesn't mean you're getting the best advice. I mean,
yeah,
take Susie Orman. She was a CFP. She had to give up her CFP designation because she was giving advice the CFP council wasn't comfortable with.
yeah. Yeah. So then ask about the custodian. We talked about that, use Schwab or Fidelity.
Yep.
And then you go a little further about confirm, uh, do they work with similar clients? Why is that? I mean,
So a lot of advisors are developing niches these days, which is great. I have clients, for example, in over 40 states, and that's because the niche that I have. I specialize in working primarily with business owners and executives doing advanced estate tax and investment planning. So things like stock options, not every advisor can do those. So you want to find, if you have stock options, you want to find an advisor that works with clients and understands things like stock options. Or if
yeah.
you're a retiree, you want to make sure that they're working with retirees like yourself.
Yeah, school teachers have a whole different kind of a pension plan. Somebody who works with school teachers is kind of like is similar. You want to work with somebody who's familiar with your industry or with your profession.
Of course. Yeah, like in my firm, we have someone that specializes in teachers. That's all he's done for over 20 years in his career, just to handle the nuances and the complexities with them.
You will meet with your clients as many times as they desire, or is there ever a charge on a meeting, even
No,
initially?
so CPAs and attorneys typically have what are called billable hours. So when you pick up the phone and call them, you're paying a fee for that phone call. With us, it's just that simple 1% all-in fee, or some clients will use us just for financial planning and they'll pay a separate fee of like 2,500 bucks to work with us for a year just doing financial planning. But that fee is all you pay. We're not billing you for hours or anything like that. Most clients will meet with us 4 to 6 times a year.
In the financial world, in the investment world, we classify individuals either as a active manager or a passive manager, or sometimes there's a combination like a hybrid. If you had to describe your investment policy or theory,
Philosophy? Yeah.
how would you describe that yourself?
Excellent question. And let's just kind of define those so everybody kind of understands. Passive is more your traditional Vanguard approach. You're going to buy like an index or you're going to buy a set of investments, and you're not trying to beat the market. You're just trying to mirror what the market does. It's very passive in nature because you're not making changes, hence the name passive, and you're just trying to follow what the market's doing. An active manager is someone that's trying to beat the market. They're going to do more trades, maybe a little bit different philosophy, and they're going to be trying to outpace what the market does. Our firm believes in a combination. Like anything in life, nothing alone is great, but balance is the key. So for us, for example, the S&P 500, which is the 500 largest companies in the US, it's the most common index in existence. Everybody trades and knows and loves the S&P. So we use a passive approach there because you're not going to beat with the index. You're not going to beat the S&P each year. You just want to mirror what it does. But then something like emerging markets, where we have clients invested in companies that are from China, Brazil, India, places like that, we want someone that specializes in those areas that can talk to the CEOs of those companies and help figure out if the company is a good investment or not. So we will pay for an active manager to help with things like that.
Okay. Does your firm have a minimum before you'll accept a client?
No. So our average client is 2 million, but we have clients as small as like 50,000. The reality is everybody is in a different point in their life. So we're not here to judge. We're just here to help our clients get from where they are to where they want to be.
Great. And then you have the ADV form contact below there and also broker check.
Yeah.
Please make sure to whomever you use, make sure you check those two resources and use the ask first form. So let's go to the next slide there, Paul. I
Yeah,
think
one thing I'll say real quick, when you're
sure.
looking at new advisors, oftentimes it's kind of a popularity contest. Who you like most is who you choose because you don't have a lot of information to work with as as the client trying to find the advisor. So these resources, the SEC, like the advisor view and the broker check, allow you to kind of check under the hood and get information that you wouldn't otherwise be able to get.
Yeah. Remember, full disclosure is the key in the financial services industry.
Yeah.
What do these licenses mean?
These are the most common licenses out there. These are the license, like we talked about, to sell investments. So as we said, I gave these up about 8 years ago. So the Series 7 allows you to sell everything except commodities. Commodities are going to be like oil and gas and timber and pig's feet and stuff like that. Um, the 24 is just the person that's managing all the other licensed individuals. So that's like the branch manager or regional director typically. And then the 63 and the 65 are more on the ethical side and the rules around selling, where Series 7 teaches you how to sell and what to sell. So for like the Series 65, I still hold that because anyone that gives investment advice does need that. And that covers, like I said, the ethics and around that things to get it. Getting a license might seem impressive. It's really not. I got right out of college, no previous background in investments or financial planning. My undergrad was in clinical psych, and I passed my 7, 63, and 65 in less than 3 months.
Yeah. You're probably, if you have attended all 6 weeks of this session, you're probably learning more than most people get with the Series 7. So it's a minimum qualifications for it in order to sell the security. So, uh, but they're there. One of the biggest products and one of the largest industries and the most powerful is the life insurance area. Talk a little bit about term and permanent.
Of course. So life insurance comes in two flavors. The most common one out there is term. You may have heard the phrase at some point, buy term and invest the difference. So with term, what that is that's a policy designed to cover a specific period of life. So for example, I have a client right now that's age 60, just bought a new home, has a mortgage for 300,000, plans on retiring in 7 years. They have no form of life insurance. So we're just having the client get a life insurance policy just to pay off the mortgage for the next 10 years until they stop working and retire. So as soon as they retire, she can get rid of that life insurance policy. But in the meantime, she's got the life insurance policy just to pay off the mortgage if something happens. So that's a common example of where we would use most life insurance. I'd say 98, 99% of the time, term is all you need. We use a permanent life insurance policy for more special situations. So this is an important planning piece for individuals that are trying to leave a specified amount of money behind. Most commonly, we do this with charitable planning, or more commonly with a child that has like special needs, trying to make, or a grandchild that has special needs, trying to make sure that there's money for them to help cover them for the rest of their life. Using a permanent life insurance policy is a great way to do those sort of things. So there is a time and a place for it, but most people overwhelmingly just need term because it's much cheaper and easier to understand, and the premiums are locked in, where the permanents are more complex, and those payments they tell you are locked in unless you have a whole life. they're not, and they probably will change over your lifetime. And then with the permanent policies too, they do build a cash value. And so a lot of agents will try and sell the permanent policy because it's the higher commission-based product. With the permanent, what happens is you have a cash value that's attached to it, and they'll sell that as like an investment, but they don't tell you what the cash value is there for. It's not to be an investment. It's to help with the premiums, right? So life insurance premiums look like this, right? The younger you are, the cheaper it is. The older you get, the more expensive it becomes. So the idea with the insurance or with the cash value is your premiums stay the same like this. So in the early years, you're paying more than you need to, building up a cash value, and that cash value is growing. So when your premiums get over here and you're older in life and you're no longer paying enough to cover the cost of insurance, that cash value is making up the difference. So if you mess with that cash value, you could actually blow up your life insurance policy.
Let's, for most of us, we do not need permanent whole life insurance.
Yeah.
The term is the way to go, and purchase the term for a number of years. It's the best way, inexpensive way to purchase, to have insurance. Let's go to the next slide.
Of course. So annuities. Annuities are originally were designed to be a self pension. So for those that are teachers or government, or maybe you're lucky in the private sector and your company offers a pension where it gives you that paycheck for the rest of your life once you retire, an annuity was designed where you would give a insurance company a lump sum of money, and they turn that lump sum of money into a guaranteed paycheck for the rest of your life, or if you're married, maybe your and your spouse's life. Um, Over the last 30 years, annuities have become much more complex, and now they're used more commonly as an investment vehicle. And so instead of having what's called an immediate annuity, which is the traditional annuity that I described, that paycheck for life, they instead use it as an investment. And that comes into what's called the deferred annuities here. And there's three types. The fixed annuity works like a CD. Okay. You put your money in, you get a guaranteed rate of return. Current rates were around, current rates on that was around 4 to 5%. With interest rates coming down, they're coming back down. But with this, you have a guaranteed rate for a period of time, typically 5 or 7 years. And then after that, the interest rate adjusts to whatever the market interest rate is at that time. So if you have an older contract, you may be only getting 1 or 3% on that annuity. Variable annuities were really popular. They're still sold today. They were really popular in the 2000s, 2000 through 2015 or so, 2016. And a variable annuity is where you're putting money into the annuity, and then you have the money invested in mutual funds, which are invested in stocks or bonds. And so you have market returns linked to that. So if the market does well, you can make money in that annuity following the market. But with those annuities, you also carry the investment risk. So if we have a down year like 22, where the markets were down 20%, you're going to have a 20% loss in that. A lot of people didn't like that downside fluctuation. So a lot of people have moved to what's called an indexed annuity. Index annuity, on paper sounds like a magic bullet. It sounds amazing because with an index annuity, your returns are linked to a specific index. And so you are supposed to have the upside of making money based on that stock index, most commonly the S&P 500. But if we have a down year like 2022, where the market was down 20%, well, then your return that year is just zero. So you don't make money that year, but you're not losing money, which is more important. So a lot of people have gravitated to these index annuities because how they're sold is you have upside, but you have no downside risk.
Yeah.
And
Index annuities are mostly sold now through your lunch, free dinners and free lunches, and they carry just an enormous commission.
yeah, and we'll talk about the challenges with each of these over the next couple slides. But if something sounds too good to be true, it's because it is.
Yeah. Index annuities are there. You
Yep.
get all the gains. We take the losses.
Not so much.
Oh, yeah.
All right. So another layer with annuities is trying to understand the fees that you're paying because it's very hard and it depends on the type of annuity that you have. Now, the one fee that all annuities have is called a surrender fee. The surrender fee is locking you into that annuity contract for a period of time. So this was a real client that came to me. This annuity was sold to them. Client invested 100,000 to the annuity. If they decided 6 months in, you know what, I don't want this annuity anymore, for them to walk away, the insurance company is going to charge them an 8% penalty. So they're going to walk away with 92,000 and the insurance company is going to keep that $8,000 surrender fee. And that surrender period typically is somewhere between 7 to 10 years. I have seen them as long as 20 years. I think, Peter, you've seen one even longer than that.
I've seen them, especially for school teachers and professors. I've seen them to be 15. I've seen one that was 35.
Jeez.
Annuity surrenders, the surrender charges are usually equated to the amount of commission that is paid to the agent 30 days after you sign the contract. Why is it 30 days? What's the magic number there?
So annuities are very complex instruments. There's articles from Wall Street Journal showing mathematicians have a hard time figuring out the math behind these annuities. So if a mathematician, a PhD in mathematics, is having trouble figuring out the math, I can promise you just about every advisor selling these has no clue how these actually work.
And what is the 30-day? What does that
Oh,
mean?
sorry. Yeah, to the 30-day. Thank you. Because of the complexity of these products, it's the only one out there that I know of that after you have 30 days to walk away penalty free. So this surrender period does not kick in until day 31. So if you get to day 28 and you get buyer's remorse and you're like, I just want out, they give you your money back, no questions asked.
It's similar to, I usually compare it to a timeshare sales pitch. You have 3 to 4 days to rescind that contract. Here you got 30 days to rescind because it is tough to understand. By the way, commercial annuities are completely different than charitable gift annuities. So a charitable gift annuity is 2 pages long and totally understandable. Um, Commercial annuities are anywhere from 10 to 100 pages and absolutely difficult to understand.
Please show me one that's 10 pages. Everyone that I've seen is 100 pages or more.
Yeah, they're all, and the Worth magazine said that there are 12 attorneys in the United States who do not work for an insurance company that understand annuity contracts. They're that difficult. Let's go to the next slide.
Okay, so we talked about the surrender fees. Now looking at variable annuities and the fees that you pay there, there's typically four separate fees that you're paying. The first one is what's called the morality and expense ratio. This is the actual cost of the insurance that's tied to these variable contracts. Okay. And that typically is around 1 to 1.25%. And then on top of that, they have an administrative charge most of the time. And this is the fee that they charge for mailing statements, answering the phones, that sort of thing. Now, like we said, these variable annuities, they're invested in mutual funds. So you're actually invested in stocks and bonds. That investment has a fee, and that fee is typically 1%. And then there's oftentimes what's called a living benefit rider. People aren't buying these annuities and then just leaving the money there hoping it grows. If that was the case, you could just go buy a mutual fund and be done with it. People are buying these annuities because they're buying guarantees for income. So a living benefit rider will say something like you get a guaranteed rate of return of 7% per year. That sounds great, but that 7% growth rate is not on your cash. That 7% growth rate that they typically guarantee is on a made up number called your income base. So think of it like a freeway, like the toll roads when you're driving in Orange County, right? If you're driving on the 91, you can sit in the normal traffic, get through it as long as you can, or you can pay that fee on the toll road and get to your destination quicker. That's what the living benefit rider does. So your cash value is not growing faster, but the income base, the amount of income you get from that annuity is increasing, and it's typically based on that living benefit rider. With this all in, most individuals are paying a fee of around 3.5% per year. So if your annuity is doing, if you get a market return of say 6%, you're paying 3.5 to 4% in fees. Your net return is only going to be 1.5 to maybe 2% most years, if that. And that cash value is only growing at that 1.5 to 2% spread or difference.
Let's go to the next slide because I think that's, yes, this is the indexed annuity.
Uh, Peter's favorite slide.
Yeah.
So this is again a real client that I worked with, and this was in 2020 in COVID. Okay. So when you do these annuities, your performance is not based on a calendar year, it's based on a contract anniversary. So if you buy your annuity on March 1st, then your rate of return is based on March 1st to March 1st of each year. Make sense? So with this annuity in 2020, it was linked to the S&P 500. Okay. And then they have what's called a monthly index rate. This annuity has a monthly cap of 1%, meaning this individual can never make more than 1% per month on their annuity. So if the goes perfect and the markets are up every month that year, they're most they're ever going to make is 12%. That sounds great, but what happens is these annuities don't have the same fees like the variable annuity. The insurance company actually makes more money on these contracts because they're keeping that spread or that difference. So take this first month there, clients the index return was 3.285. They're capped at 1. She just paid the insurance company 2.85% in fee in the first month. We get to month 3, it's up almost 5%, capped at 1. The insurance company is keeping that 3% spread there, or sorry, 4% spread there. We go on, and then we get down here to when the lockdowns happened, March and April 2020. We all remember it. Markets were down over 10% both those months. They're not capped on the downside. They're capped on the upside, but they're not capped on the downside. So those two negative 10 months, that's a return of negative 20%. Now we add up all the other months where the market's recovered. The sum for our client, so the client's return was negative 16% for this year, negative 16%. Okay, so they get a return of 0. But that S&P 500 that they were tracking was up 15.75%, almost 16%. So they got paid nothing on a great year in the markets. Great year in the markets.
So a couple of other things too is that when you receive annuity income, is that considered capital gains or does that considered ordinary?
That's a great question. So the whole idea with annuities and what makes them attractive to individuals is tax deferral. So you put your money in, let's say you invest 100,000, it's growing each year. That growth you're not paying taxes on, it's tax deferred. You pay taxes on the annuity when you take the money out. That growth, however, is taxed at ordinary income tax rates. So, for example, if you're a couple and you're retired, if your income is less than about 100,000 per year, um, your tax rate is 0% on long-term capital gains, which is the tax rate you typically pay on stocks. But because it's coming out of annuity, you're instead going to be paying a tax rate of around 12% because it's taxed at ordinary income tax rates.
It's just really horrendous as far as taxation is concerned.
Yeah.
Not a great vehicle to give to your heirs, and you can't control uh, your capital gains income. If you look at the 15.76 return on the S&P 500, and if you kept it for a year, you're paying long-term capital gains on it. Whereas if you would have made the same amount of monies under the annuity, you would have paid your net return after taxes would be substantially lower. Let's go to the next slide.
Yep.
We're going to go into stocks.
Yeah, so let's talk a little bit here about stocks and bonds and ETFs and mutual funds. So a stock and bond is the primary investments. This is what the vast majority of individuals have. A stock is simply ownership in a company. Okay. So if you buy Apple stock, you're an owner of that stock. At the end of the year, Apple's going to have a ton of cash they're sitting on. They're going to decide to either spend that money to make new products, buy other companies, or they're going to give that money out in what's called a dividend to their owners or the shareholders of the company's stock. So with a stock, you make money when the company does well, but because you're an owner, you're also going to lose money when the company does bad. Those tend to be a riskier way to invest, but they're the way that the richest people in the world, like Elon Musk, who just hit 500 billion net worth, all that money has been made because he owns the stock of the companies that he started.
And most individuals use mutual funds to invest in the stock market and in the bond market.
Correct. Yeah. So bonds are just a loan. So think about your mortgage that you have that you're paying a bank a principal and interest over a guaranteed rate of or guaranteed time. With a bond, you're the bank loaning your money out to Apple to build the newest iPhone, maybe to the city of LA to build a new freeway or build a new school. But that's who you're loaning your money out to. So with a bond, we can tell you how much you're going to make the day you purchase it because everything's locked in, right? Guaranteed interest rate over a guaranteed period of time. They're more conservative and they're a great way to help kind of balance the risk of stocks. With an
Yeah.
ETF or a mutual fund, all these are is investments in stocks or bonds, and it's just pooling your money with other investors. So instead of you taking stocks and having to go out and buy 500 different stocks to mirror the S&P 500, you can pool your money with other investors that are trying to mirror the S&P 500, and then a fund manager will go out and buy those 500 stocks for you. So it's an easier way to invest. An ETF is like a mutual fund, just a little bit different. Mutual funds have been around since 1940. Long proven track record. ETFs are newer, been around now for about 25 years. With an ETF, they're like a mutual fund, but an ETF you can buy and sell at any time. So if a client calls and says they need money and I sell an ETF for them, that ETF sell is let's say I do it at 10 a.m. That sale is processed at 10 a.m. With a mutual fund, that sale isn't processed until 1 p.m., which is when the market closes. That's the key difference between the two.
Yeah. There's literally 20 to 30,000 mutual funds out there, maybe even more. And there's only like 30, I think there's about 4,500 stocks. So they're not all created equal. And let's go to the next slide because we'll talk a little bit more as to how to figure some of this stuff out.
Yeah, and so as we talked about before, like with the variable annuity, I had mentioned a fund expense. So when you invest in a mutual fund or an ETF, there's a fee that you're paying. Historically, that average fee has been around 1%. Unfortunately, with most insurance companies, they're still around 1%. The nice thing is over the last 20 years, we have seen a lot of fee compression, fees coming down in our industry, which is great for investors. So for a stock mutual fund, back in 2000, the average fee was 1% per year. Today, that average fee is 0.42%, so less than 0.5% per year. And with bonds, same thing. ETFs, the nice thing about ETFs is they do tend to have lower fees than mutual funds. So, for example, a bond ETF today, that fee is 0.11%. So, incredibly low.
Yeah. So when you make an investment for your clients, one of the first things you look at is keeping the fees as low as possible. Is that because you can control that?
Yeah, so the if you want to be key, the two keys to investment success are keeping the fees as low as possible and keeping the taxes as low as possible, because those are the two biggest things that you can control to give you the best chance for outpacing the market.
Yeah. Let's go to the next slide.
Of course. All right. So with mutual funds, there are different what are called classes or types of shares. So take the S&P 500 with Vanguard. S&P 500 with Vanguard, there's not just one to choose from. There's actually about six or seven, I believe, different versions of the same mutual fund that you can buy that can get bought at Vanguard. And those are in different forms from institutional, which is what we buy for our clients, which are the cheapest, have the lowest annual expense ratio, to ones that are sold with commission based. So if you walk into a JP Morgan branch and you say, I want to buy the S&P 500, they're typically going to sell you what's called a load fund. So they're either going to sell you what's called a Class A share. This has a large upfront sales charge, but then has a much lower annual sales charge or ongoing fee. That upfront sales charge, though, is typically around 5.75%. So if you invest $100,000 into an A share, on day one, you're paying a commission of $5,750 to the bank and your broker, which is, I mean, that's split between them. And then your starting account balance is 94,250. So you're starting behind the eight ball day one with a share. The way that they kind of hide this or how they go about it now is few people are doing A shares anymore. Almost everybody's now selling C shares. They sound great on paper because there's no upfront sales commission. So if you invest 100,000 on day one, all 100,000 is invested. The downside to these is they have the highest annual fees of any type of mutual fund in existence. That annual fee is on average around 2% per year. So a lot of advisors are selling this because there's no upfront sales commission. It's an easier sell, and they're making that higher commission each year based on that 2%.
And how would a typical individual find out what kind of mutual fund they have and what are their expenses and fees that they're paying? Is it easy to find out?
The easiest way is to look at your statement, and it should say on the statement A share, C share, B share, institutional. You should see a word like that telling you the share class that it is. Another shorthand, there's something that I use all the time, is in every mutual fund in existence, all 30,000, like Peter Kote said, have what's called a ticker. It's a 5-digit code that's used to track them. That code for a mutual fund always ends with X as the last letter, but that letter just before that X oftentimes is the share class. So it may end in AX, CX, IX. I would be for institutional. If you see an A or an C as that second to last letter, that most likely is telling you the share class that mutual fund is.
And use the artificial intelligence or Google and put that share class into Google and say, what are my fees? Or what is the expense ratio? And it should come back to you with a fairly quick, easy answer.
This is a great time to use AI. So
Yeah,
ChatGPT, Grok, any of that. You can just type in the name of the fund or just type in the ticker, ask it what all the fees are, and it'll give you the full breakdown of the annual expense ratio, sales commissions, all that.
yeah. For most of us, we want to keep our fees as low as possible, and we call those no load mutual funds.
Yeah, and this is where Vanguard became the behemoth that we know it as today, is because for 40 years they were just selling mutual funds with no loads. So you used to not be able to get a Vanguard share from an advisor. You had to get it from Vanguard itself. So these are typically sold directly from the mutual fund company with no commission. These days, I mean, you can go to Fidelity, and Fidelity has no load funds. Schwab has no load funds. So
In when you're in a mutual fund, Do mutual funds have to pay taxes when they sell a stock within their portfolio?
Depends on where the account is held. Okay, so for uh, let's say you buy a mutual fund and it's inside a retirement account like a 401k or an IRA.
Uh-huh.
No, those are going to grow tax deferred. But if you have it in, say, a taxable account, that's a account that's not a retirement specific account. Then when you sell the investment, you will trigger taxes at that time on the gains. So if you bought it for $100 and you sell it for 120, that $20 gain would be subject to taxes in a taxable account.
Yeah, but there's some mutual fund managers that turn over their portfolio 3 to 4 times a year and incur ordinary income taxes throughout the year. Who pays those?
So, yeah, so with mutual funds, there's a smaller thing to consider that isn't well known, and that's the capital gains distributions that you're talking about. And so that is typically paid out at the end of the year. Most of those get paid out in around this somewhere between now and December of each year. And the individuals are going to have, the investors are going to have to pay taxes on that. That is gains that have occurred throughout the year that are being paid out to you.
So one of the things you want to take a look at is to see how much trading does the investment manager do in that particular mutual fund.
Yeah, and this is the two big appeals of ETFs and why they've become so popular. One is because they historically tend to have lower fees, as you can see, compared to mutual funds. The other big thing is what Peter's talking about here with that capital gains distributions. Those only occur in mutual funds. You do not get those with ETFs.
Yeah. You cannot control your return, but you can certainly control your fees and you can control your tax issues when you're
Yeah.
investing. Let's go to the next slide.
So this is just looking at the returns for the stock market every year, going back from 1926 through 2024. So if we take a look at the worst years here, you'll see here at 2008, third worst year in stock market, second worst year in stock market history, return of negative 36% that year. But what we see here is we tend to have far more positive years than negative years, and the scale of the distribution tends to be much larger. So why people invest in stocks and bonds is because 3 out of 4 years they should have positive returns. And you can see here those positive returns tend to be much higher. So we take the losses of 20 to 30%. I only got 3 times that, really 6 times that we've had a loss of 20% or more in the stock market. But look at how many years we've had a return of 20% or more positive in the stock market. So this is the type of risk return that we like to see, where things are much positive than they are negative.
And with investing, there's always a risk.
Only guarantee I can give you within any investment is if you stay invested long enough, at some point you will experience a negative return.
Yes.
Only thing I can guarantee within any investment. When
This
we
is a,
look, sorry, go ahead.
no, this is right on point as to your statement. What should we do?
So what you should do is buy and hold. This is the most oldest and the most proven strategy to work with stocks. So the idea here is we don't want to do a lot of trading. So when we buy a stock, we want to hold it for at least 1 year. If we hold it for 12 months, we get that favorable long-term capital gains tax rate. Like I said, if you're a married couple, retired with income less than 100,000, you actually pay zero taxes on your capital gains if you've had it for 1 year or less. If you trade it short term, maybe you hold the investment for 6 months or 9 months, then you're going to trigger income tax rates on that gain. So we like to hold it for a longer period of time. And you can see here, the return is much more predictable the longer you hold the investments. If you said in January of the year, is the market's going to be positive or negative? I'm going to tell you 3/4 chance positive because based on the last slide, if you ask me what the return is going to be, I'm going to kind of tell you to flip a coin because I have no clue to figure that out. Now, if we hold the investment for 10 years, we know it's going to be far more predictable than holding it for 1 year. So this is the range of returns that you can have.
Treasury bills.
Treasury bills. These are debt from the US government to do their thing. These are very stable, as you can see. The nice thing with the 60/40 portfolio, which is 60% stocks, 40% bonds, this is the average portfolio for a retiree. You can see here the probability for negative returns decreases dramatically. So for a stock over 1 year, you have, 24, 1 year here, 19. You can see here just if you've held a 60/40 portfolio for 10 years, your chance of having a negative portfolio based on historical returns is 0%.
Yeah. These charts are about negative returns, not
Yeah.
positive returns.
Yeah. So we want low numbers here. It's like golf.
Yeah, we want low numbers, not high numbers. Let's go to the next slide.
All right.
Oh, I love this one.
Okay. So everything today that we talk about with investments, almost all of it is based on what's called modern portfolio theory. It was a theory done back in the 60s, I think it was.
Hmm.
So, and the basis of that was the markets are efficient. I don't know about you, but the little I do know about human psychology based on my undergrad in clinical psych and my experience working with individuals is humans are completely irrational. So, and this goes back centuries. The first mania that we saw was in 1636, the Dutch tulip mania. We had tulip flowers that were being sold for hundreds of dollars in 1636.
Yeah, pretty amazing.
It is. And these have been going on, and unfortunately, they're just becoming more and more frequent these days. So, going back to the 1900s, we had like five main ones. We've had three in less than a last 50 years with the dot-com bust, the housing crisis, and then we're seeing now with crypto and the GameStop and all that. These investments are driven by what's called FOMO, fear of missing out. You see your neighbor, you hear about people on TV talking about how they've made 100% returns or whatever the case is. So everybody piles in because they want to get that same return. Human nature is called herding. However, it's actually the exact opposite of what we wanted to be doing as an investor, right? Because we all know the old adage, buy low, sell high. So we want to buy here, sell up here. What happens with most investors is they're buying high, they're chasing whatever's best today, and today's winners tend to be tomorrow's losers. Every market is kind of self balancing. So if the pendulum swings too far one way and we have great returns for an extended period, that pendulum is going to swing back and have lower returns for an extended period to offset it to get us closer to that historical average. So with these manias, people buy high, take a big loss, they sell their loss and they get out of the market, locking in those losses. And then because they lost money, they're afraid to go buy again. And that creates a negative cyclical loop. And that's why the average retail investor, their return versus the index is typically 1 to 2% lower than what the index does or what the market does. And it's because of this emotional component with it. So when investors are hiring advisors like myself, it's oftentimes not because we're far superior stock pickers. It's because we can help handle that emotional distress and help avoid clients from making emotional based decisions. I manage money for two other advisors that are more than capable of doing it themselves, but they've hired us because they recognize that it's impossible to separate your emotions from your money. It's just impossible. We can't do that. And so they will hire us just to help avoid those potential flaws.
Yeah, same here, Paul. I don't manage my own money because I'm way too emotional when it comes to my own money.
Sure.
I want somebody totally neutral and to manage my money. And I've done that for the past 10 years, and I could see just a total improvement in my return Don, I think you might have a question for us.
I do. So we talk about all these different things that buy and hold and does that. So how often should you rebalance a retirement account, 401k, IRA, whatever it happens to be, across bonds or stocks?
And
Yeah, and
what
I
does
think you
it
guys are
mean? Before you answer that, one additional question. What does rebalancing mean?
okay. I
Thank
believe you
you.
will be covering this more in depth next week, but I'll give you a quick primer.
Okay.
Rebalancing means how often should you be selling your stocks? So, like I told you, the average retiree is 60% stocks, 40% bonds. Well, what happens, because if you remember here, we talked about the market returns. Um, the returns for stocks tend to be much higher than bonds. So in a good year, your 60-40 portfolio might become 65% stocks because the stocks are giving you better returns than the bonds. So at the end of that year, you just want to sell 5% in stocks in this example and go back to that 60% stocks. The whole idea of rebalancing is twofold. One, we want to take from today's winners to buy tomorrow's losers. So the things that did really well this year, we're taking money out of, and we're putting in things that did bad this year because most likely they're going to do well next year or very soon. So it's keeping us number one is keeping our level of risk locked in to what we're trying to be. Because if you don't do this, your portfolio that starts at 60% stocks in a few years may become 80% stocks. And then if you're 80% stocks and you have that big loss, you're going to have a larger loss than you would be comfortable with or should have had. So rebalancing is a way to help keep the portfolio on track. How often you should be doing that? That varies based on tax implications and investors' concern or investor sentiment. At minimum, we want to be doing it once per year.
At least take a look at it to see if you'd need it. Most individuals that I have met is that the buy and hold strategy has worked really well for them, even if they didn't rebalance, you know. So
Yeah,
just buying and selling is part art, and we're going to get into that more next week when we talk about the investments. Let's go to the next slide.
that's it.
And one of the things that I want to talk a little bit more with you, Paul, on
Yeah.
in the investment world today, are partnerships a good place to be?
Okay, so outside of stocks and bonds, there's a lot of different other asset classes. One of those are master limited partnerships, MLPs, or partnerships in general. Those come typically in one of two flavors. One is investing in oil and gas, where essentially you're most of the time these are buying wells that are producing oil, and then you're getting that income each year from it. So there's an attraction for retirees because you can buy this as an income source in retirement. The other type is investing in real estate, where your money's pooled with other investors. Now you're getting rental income coming in. So again, can be a good source of income in retirement. So that's why people tend to look at them. Those structures are very opaque. Is that how you say the word? They're tough to look at. The biggest concern with these type of investments is they tend to be very illiquid, meaning you can't get access to your money. If you need $50,000, you don't have the ability to pull it out of the account because it's going to typically be locked away for a period of time. These investments typically have a lifespan of 7 to 10 years. We have a client we put in a real estate one in 2006, and we're in 2026. It was supposed to be a 10-year investment. The money's still locked up for some of our clients.
So one of the things too is that in today's investment world, we can choose to have our money in a bank. We can choose to have our money in a credit union. We can choose to have our monies at a discount brokerage firm or a full service brokerage firm. What would you suggest for the what might be a good fit for us as a consumer?
But before you
Um,
answer that, but Paul,
yeah,
before you answer it, you haven't talked at all about private equity, private lending, private alternative investments.
yeah, I was going to cover that here. Thank you for bringing that up. When we look at investing as a whole, you can really think of it like a pizza, where a pizza has, 10 to 12 slices. There's really about 10 different 10 to 12 different ways that you can invest that money, whether it's in things like gold, other precious metals, could be real estate, could be investing in private businesses. That's typically going to be done through like private equity. Maybe you hear about all these new startups and technology coming out of, Silicon Valley, and so you want to invest in these startup technology companies. That's going to be typically what's called venture capital. So there's a lot of these sort of alternative investments is kind of the all-encompassing word for this. And we do this for clients here, and it is beneficial to have a small percentage of your assets in these alternative investments because they have a risk profile that's different than stocks. So historically, if stocks go down, bonds go up, where these other kind of investment classes are kind of not linked to that, correlated to that at all. And so their returns aren't linked to that. So it gives you a little bit more diversification in the portfolio, but they do come with considerable risks. One, because they tend to not be as highly watched or controlled with laws like stocks are. So there's a little, especially when you get into things like crypto, which is the wild, wild west these days. Or they can have high fees, and they can be, especially if you're doing it privately, it can be very difficult to understand what you're investing in and understand the fees. And there's that liquidity problem where you may not get access to that money for a very long time. So for most investors, you can invest in these sort of things, and you can do it through places like Schwab or Fidelity. And there's ways to do it where you're not investing directly with the company. So you have liquidity. A common example with this would be what's called a REIT. That's a real estate investment trust. That's again, just think of it like a mutual fund, but buying portfolios of real estate. With these, historically, they were private, where you did it directly with the company that's doing the investing. Now, these days, you can buy and sell those shares typically on like an exchange like Schwab. So it's much easier to get in and out. So if you do it privately with a company, you can't really get your money out of that. But if you do it on Schwab and you want out because you're concerned about commercial real estate, so you want out, you can have your money in 3 days.
Yeah.
So
Liquidity becomes very important as we get older.
yeah, I mean, I think you guys have probably talked about this, but most people's lives are staying in two phases. Your accumulation phase before you retire, where you're building your asset base, and then you retire, you're in your depreciating phase where you're living off those investments. This side, we want the risk and we want that upside growth. Once we're retired, it becomes more important protecting the money than it is growing the money. So things like liquidity become paramount.
Yeah. Just remember that uh, these the institutions today want to be all things to you. Credit union, not only there's a kind of like a banking relationship, but they also lend you money for your cars. They sell annuities, etc. So banks at the same time will sell you a CD, or hey, walk over to another counter and there's a salesperson there that'll sell you stocks, bonds, and mutual funds. Um, what is the difference between a discount brokerage firm and a full service brokerage firm?
These days, nothing. They're one and the same.
Well, there's a little bit of difference between a Schwab, let's say, and a Merrill Lynch. A little bit.
A little bit, a little bit. I think of it more like Robinhood versus Schwab is more how I
Yeah.
would think of that. Where the bigger the firm, the larger scope of services that they can provide for you. Like, for example, if you want you can get a good annuity through Fidelity or Schwab. You can't do that typically with like a Merrill Lynch, where because if you go through like Merrill Lynch, now you're going through a broker. Now you're going to be paying much higher commissions and fees.
Yeah.
I would say that's the biggest difference is the fee structures that you're paying. The larger Schwabs like Vanguard, Schwab, Fidelity, fees tend to be much lower and much more transparent on that. Whereas if you go to a smaller place, the fees tend to be higher and it's harder to understand and more limited options.
What about online banks? Do you have any thoughts on those?
Yeah, those are extremely popular. I mean, I myself bank with USAA. It was the first online bank. There's no brick and mortar branches to go through. But if I want to deposit a check, I can scan it and just deposit it and it's done. And for a lot of savings accounts, especially, the best savings accounts tend to be online only. Whether that's like Amex high yield savings. For our clients, we use a bank called Flourish, which is currently paying like a 3.75% interest rate, all FDIC insured. So you can get higher interest rates on your savings typically through an online bank.
Yeah. Um, the session is called the Investment World. Here in Orange County, we're probably a bit more wealthier, at least in property, et cetera, than most other parts of the country. And we're more subject to scams. How can, you know, with AI, artificial intelligence, the scams are getting more sophisticated all the time. Can is there a Do you ever get calls from your clients as to say, hey, should I do this? Or what's your thought of how to prevent from being scammed?
Number one is always check the source, and number two, never click the link. So, for example, um, not necessarily money related, but I personally just got an email that went through my spam filter with Google for my Google email and came in, and it was someone acting like my password was being reset with Facebook, had the Facebook logo and all that. Um, and it looked legit. It was one of the best scams that I've seen. How I spotted it and double checked it was a scam, I didn't click the link to find out. You never do that. Don't ever click the link. But if you click on the email address that it's coming from, it wasn't facebook.com. It was Facebook or no, it was Facebook, but with three O's.com. So I could see it was coming from a fake website, not from the actual website.
Why don't you? I think your next slide is just your contact information, I believe.
Before we, Pete, we have a
Yes.
question. Is there a comparison site to find interest rates, different interest rates between online or offline, or how can I research what's available?
Feel free to reach out to me if you'd like. AI again can be a good resource for that. Most commonly, people use bankrate.com.
Okay. This morning, incidentally, I noticed an email that had come into me, speaking of spam, that said, "Oh, we have to get into the two-part verification system and set that up and everything else at your bank." And I thought, well, first of all, it didn't have a logo for my bank. Secondly, it didn't say what bank it was from. Third, I'm not about to click on that link. So I'm with you in terms of doing that one. I want to do something, however, Pete, we were going to do a poll. So I'm going to
Yes.
launch the poll.
Yes.
So we're launching a poll to you. And
Let
what
me.
this says is, what kind of financial advisor do you use? I use a CFP. I use an advisor from a brokerage firm. I listen to my friends. I do it myself. And incidentally, it's multiple choice. So if you want, you can have all of those. But you're welcome to fill that out. We'll get you the information in terms of what it said in just a minute. So we'll give you some time to play with that.
Yeah.
Thoughts or
Uh,
comments, Pete?
Yeah, well, just for today, for example, I I use a bank for a checking account, but for all my investments and everything else, I use Schwab. I don't get paid by Schwab for saying this either. But the reason why is that because I can get a mutual fund, a money market mutual fund that pays substantially higher than any bank will pay.
Yes and no, Pete. That spread has come down. Me and Mike were doing that. Mike is my partner for those that aren't familiar with Mike Albee. He's actually our chief investment officer for the firm. And that spread, that difference. So yes, you were getting more with money market versus savings. That difference right now is nominal at best.
Nominal at best.
Yeah, and so typically when people are asking me for like where to put your money for savings, I typically say if you have like a credit card, like Amex always has a great savings account rate.
You
Capital
you
One,
said Emax, E
American Express.
Oh,
Amex.
American Express.
Amex.
Okay.
American Express, Amex, whatever you want to call it. They always have some of the best savings rates. A highly reputable company. Capital One, again, if you have a credit card with them, they have great savings rates as well. So those are good places to start if you're looking for a good savings account.
And Don, what's the result?
There you have them right in front of you.
How you
Use
doing?
the CFP
5% use a
25?
CFP, 17 brokerage firm, 8 listen to friends, and 75%. And again, these don't add up because you can have multiple choice. So
Yeah.
you can get different kinds of them in terms of what's there. So just interesting from that standpoint.
Okay. So if you got anything out of today's session, I'm hoping that you got to take a look at your investments and see what is your expenses that you're paying presently for your investment vehicles. It's crucial. Two is that if you have a mutual fund, is it earning capital gains or is it earning ordinary income? Those are the two things that you can control. Is there anything else that we want to add, Don?
There's one thing that came in on the chat, and again, we said we weren't going to be following this in terms of answering questions. Can you touch on conversion from an IRA to a Roth? And I'm going to say you should log in tomorrow because we do retirement planning on the estate plan. So I'm going to say that's where it is, as opposed to the investment world side of this. That's a whole nother issue in terms of.
Let's.
Okay, Paul, go ahead. Answer the question.
No, I'm going to ask Paul this because a good financial advisor is a number cruncher.
Yep.
And so the number, you got to do that question is a perfect example that you have to crunch the numbers. What numbers would you crunch, Paul?
All right. So doing a Roth conversion, we're taking money out of a tax deferred account, move it into a Roth account, which grows tax free. So the benefit here is getting that tax free growth for the rest of your life. But when you do this conversion, you're triggering taxes, right? Because it's going from money that's never been taxed to money that's after tax. So you're creating a taxable event with these conversions. So how to calculate how much to do takes tax planning. The first thing that we need to do is figure out what your tax rate you're going to be in. Because if you're in the 24% tax rate, for example, and we do too much, that could bump you from 24% to 32%. And so you may be paying excessive taxes if you do too much. Then aside from that, we need to look at other things as well. If you have a lot of long-term capital gains, if we go above 200,000 for an individual or 250,000 in income for a married couple, now we're triggering what's called NIIT, net investment income tax, which is a 3.8 surtax that you're paying on your long-term capital gains. So we have to take that into account. And then if you are 63 or older, now we have to look at your Medicare premiums, because your Medicare premiums, everybody goes on Medicare at age 65 typically, and your premiums that you pay are based on the last 2 years of income. So if you go above a certain threshold, instead of paying $100 a month, you could end up paying $600 a month for the same insurance coverage because you did too much of a conversion. So that also needs to be taken into account. So when we're doing these Roth conversion plannings, it's not just an investment decision. It's not just a tax decision. All these different factors need to be looked at. I strongly, strongly recommend you work with a professional, whether it's a CPA that knows this stuff or a financial planner that knows this stuff, to ensure you're not triggering additional taxes or insurance premiums, which to me is just another surtax because that's money out of your pocket. And so we got to keep all these sort of things into account.
Yeah.
The other part of that interest is how many years you're going to hold the Roth before you start using it.
Yeah, that's
I
got to.
think there's a 5-year statute on that one.
Yeah, it's the if you were just to answer the question and say, is a Roth conversion a good thing? Yeah, the opportunity there is wonderful, but whether or not it's applicable to you, that's a whole different question. It's also the same thing for another product that's very popular and being sold on lots of TV programs is the reverse mortgage. Is that a bad product or a good product, or is it again one of these that you got to crunch the numbers?
You got to crunch the numbers on a reverse mortgage. It's typically the last arrow used for an individual that has no other assets to live from.
But that's
Uh,
not how they're sold.
what you just said, how they're sold, same thing with annuities and permanent life insurance. They're great tools for the right person, the right circumstance. I've used each of these different products for my different clients at different points in time because it made sense around their circumstance. But for most individuals, by and large, you're not going to need an annuity. You're not going to need permanent insurance. You're not going to need a reverse mortgage. They're good to know about in case you ever do, but for most individuals, it's just not something you need to worry about or think about.
And remember, the investment world today is about selling. Okay, it's not about number crunching. You don't hear those kinds of commercials.
I disagree a little bit, Peter, because 20 years ago, I would have completely agreed with you. 20 years ago, we still had brokers that are dialing numbers from a phone book trying to sell and pitch a stock. That's gone today. We don't have that anymore. It has moved more to number crunching. We've seen more people break away from their broker dealers, become independent advisors, trying to do right in their client. And AI and technology has kind of forced people to focus less on selling and focus on differentiating yourself with services like financial planning.
Yeah, that's where the licensing comes in and et cetera. Do we have another question there, Don?
There was a comment. I had raised the issue of the 5-year hold period, and I'm not certain of that one. And certainly I would defer that one to Michael tomorrow in terms of what we're going through on it. So that's what.
Yeah, I would
Sorry.
say kick that one down the road because there's actually two different 5-year rules with the
Yeah.
Roth. I can discuss them, but that's another 5 to 10 minute conversation in it.
Yeah, most of these are. Anyway, you want to do the closing there, Don?
That's an interesting question. First, if one gets a large inheritance, what would be a good place to put the monies for a 69-year-old woman?
That is a great question. I'm happy to answer offline. But I need to know things like time horizon. Are there any goals relocating or buying a home or paying for grandkids' college? What are the income needs?
What is your
What are the
goals?
what are the
Kind of
tax
risk can you
situation?
take?
You got it.
Is
So
it? It's just
something like that, feel free to reach out to me.
yes.
Happy to talk to you. Always will happy to do a complimentary consultation and just answer questions and educate you and give you some food for thought and go from there.
Yeah.
There was also one comment in terms of please provide the link to tomorrow's meeting. If you go to iyme.org, same site where you registered for this session, you can register for that one just as easily. And it's simply the It's Your Estate session that's there. So that's the answer to that question. Are you looking for something, Pete, or do you want to?
I was just going to type in the our website that they
Okay,
can
yes, you just did.
register themselves if they want to see the program, which is going to be Michael Simon, which will be
And
excellent.
and just as a note, Pete, thank you very much. You sent that to Paul and I. Why don't you
Okay.
say everyone, and then they can see it
Okay. Are
since you
going
type
to do
so
that?
well.
I'm just learning.
Yes, I know.
This is
Are
all
you
new.
are you doing it
Anyway,
or am
I
I?
got
Paul, I
it.
want to thank
There we go.
you. I
You got it,
love your
Paul?
program and your expertise and your willingness to share. Paul does this on a complete volunteer basis. And and again, I just want to reiterate, if you give him a call or send him an email, he'll schedule a time for you. There's no charge, and he'll give you some time and to help you out. And really appreciate that, Paul. All
So
Of
with
course,
right.
that's a
that,
pleasure.
I thank you, Paul. I thank you, Pete. I thank you, audience, for attending. This has been It's Your Money. We've been talking about the investment world, and I thank you very much for being here. And this recording will be on that site, IYME, probably within the week. So, Paul, thank you. Pete, thank you. Been fun.
Thank
Take
you.
Bye.
care.